Welcome back. Well, interest rates up again. Yesterday, the Federal Reserve announced the 6th change this year. Joining me now to talk about that is our local financial advisor, Bruce Allen of Bruce G. Allen Investments. Good to see you.
Good morning, Gary.
Yeah, so talk about the increase, what they do yesterday, and what's it mean?
Well, yesterday the Federal Reserve unanimously raised rates another 0.75 of a percentage point. So we've seen rates go up very dramatically this year.
Yeah.
We've seen them go up rapidly. And they talked a variety of things, but basically they're concerned about the level of inflation that continues to remain very high.
Yeah, I think maybe they thought that raising interest rates some time ago would help inflation start to come down, but hasn't had much of an effect yet.
No, not so far. What he said yesterday in his statement was really interesting. He said three things. Basically, number one, we're starting to see the Federal Reserve's we're starting to see the economy slow down. We've seen that particularly in some of the interest rate sensitive areas like housing. Number two, he said, we are fully committed to fighting inflation. His tone was, as some people on Wall Street call hawkish, meaning he said, we're committed, we're going to raise rates higher than previously thought, and we're going to keep them up here higher than previously thought. And lastly, he said rates are going to go up higher than we previously had estimated. And the market interpreted that as, hey, rates are going to top out at 4.5%. Right now they're at 4%. Now the market is guessing that the rates will top out at 5%, possibly even higher than that. And we've seen rates go up dramatically this year so far. They started out at 0.25%. They're up at 4% right now, just under 4%. And if we're headed to 5%, this is really a very quick raise, a quick pace of increases that the Federal Reserve is doing.
Of course, the market doesn't like that, and one of the reasons is it affects almost everything that you use credit for, right?
I think that's part of it. I think the big thing that Powell said yesterday was that he mentioned a couple of times that the economy might suffer, and he particularly referenced the jobs market being, quote, unbalanced. And that's Fed speak for we're going to raise rates, and even if we want the economy to slow down and cool down, and that may mean it goes into a recession. And he's very unapologetic about that in terms of we must fight inflation, and if we have a recession, so be it. And the problem is that costs potentially of the 160 million job holders, we may have 2 million job holders lost.
So what does this mean for you and me?
Okay, first off, short-term rates are higher. That means we'll see higher rates on mortgages, car loans, credit cards, things of that nature.
Right.
So we've seen that already. The mortgage rates were 3% at the beginning of the year. Now they're over 7% and possibly going higher. The other side of that is that short-term interest rates are also higher. So when people get their money market statements, their bank statements, all of a sudden they're actually seeing some money that they've earned on interest as opposed to nothing, or very near nothing. So those rates are going higher. It also means that the stock market will likely be adjusting to these new rates, and that means where the market goes, nobody knows. But the market may have some more sell-off to adjust to these new increases in rates. But once we get to that point, Gary, once we get into a recession, and I'm assuming that that's where we're headed because the bond market is predicting that we're going to have a recession, interest rates drop and they go down a lot. And it's likely that when we hit that point, and who knows when that's going to happen, we're going to see interest rates come back down significantly.
It'll be interesting, up and down for the stock market. Good to see you.
You too, Gary.
Take care, my friend.